Welcome back, guys. Welcome to another video of Forex Beginner's Guide, video 105. Today's video, I'm going to be covering how to follow risk management, one of the most important topics. So, what is risk management in Forex? In Forex trading, risk management is a process of protecting your capital by using strategies that minimize the potential of large losses. Since the markets can be so unpredictable, especially when you're trading a volatile pair like gold, which is also known as XAUUSD, risk management is essential to ensure long-term success. It's like having a safety net for your trading career. Proper risk management helps you to control the amount of risk you take on each trade, ensuring that if you experience a losing streak, it won't wipe your trading account. There's five key risk management strategies that you can use. First one is positioning sizing, which is also known as positioning your lot size or calculating your lot size, which I'm going to be making a separate video on. So, position sizing references to how much you trade in each position. Okay. A common mistake new traders make is they risk too much on a single trade. That's not how it should be. By determining this position, you can control how much you stand to lose if the trade doesn't go in your favor. Okay. Now, example, if you've entered a trade at 1800, you want to limit your loss and make sure that if it doesn't go in your favor, you don't end up losing the entire amount. So you want to limit your risk by putting a stop loss and by positioning your sizing or like putting the lot size of appropriate number. So the next one, risk to reward ratio. The risk to reward ratio is the relationship between the amount of money you're willing to risk and the potential reward. A common recommended ratio is 1:2. This means you're balancing risk with a potential reward, ensuring that if you lose some trades, your winning trades will be more profitable to cover your losses. Example, if you're willing to risk $100 on a trade with a stop loss of, let's say, $10 per ounce, you should aim to profit at least $200 once it goes in your favor. Third, use stop loss and take profit orders. There's a video 103, 104 where I've explained what is a take profit and what is a stop loss. If you haven't seen them, go watch them now. As we already discussed, stop loss and take profit are key tools of managing risk. A stop loss protects you from losing too much by automatically closing your position if the price moves against you. A take profit locks in gains when the price moves in your favor. Setting both of these orders ensures that your profits are protected while limiting your losses no matter what happens in the market. Fourth point, never risk more than 2% of your capital. One golden rule in risk management is to never risk more than 2% of your trading capital on a single trade. By risking only a small percentage of your account, you protect your capital and avoid large losses that could take you out of the game. Example, if your trading account is 5,000, you should never be risking more than $100 on a single trade. You want to play smart. This is a long-term game, not a get-rich-quick scheme. Number five, diversify your trades. While trading gold, while trading can be a great opportunity, it also is important to diversify your portfolio. Especially when you're trading gold, you want to diversify. Instead of putting all your capital into a single asset, consider spreading your risk across multiple trades in the market, of course, following risk management. This way, if one trade doesn't go well, the others can balance you out with your losses. There's an also very important video which I'm going to be making about layering, which can allow you to enter into the market at different points that can be beneficial. So these were the five key points. I'll be making that video very shortly as well. Why risk management is crucial for XAUUSD/gold. Volatility. Gold is known for its volatility, meaning the price can swing rapidly in a short period of time without proper risk management. These fluctuations can lead to significant losses. That's why it's crucial. Number two, capital preservation. Even with the potential of large profits, the goal of trading is to preserve your capital while still achieving gains. Risk management ensures you don't take unnecessary risk. Number three, longevity. Traders who consistently follow good risk management strategies are more likely to remain profitable over long term, even though rough periods in the market appear. Okay, so this is why it's crucial. These were the main things about risk management, guys. I hope you all got value. I'm going to finish this video here and watch the next video to gain more knowledge. The Forex Beginner's Guide, carry on. Take care.